The United States, which ironically is the most indebted nation in the world, is trying hard to push its allies to keep paying into the US economy and keep funding the massive debts of the nation. What makes this even more disturbing is that the US is making it clear that they do not care about the local economy of its allies, be it Canada, Europe, or Japan. In this video, our focus is on the current situation between the US and Japan, as the Trump administration is putting increasing pressure on Tokyo and demanding more. However, this time, Japan is saying, enough is enough. The message from the White House is more like a threat than a request. Wreck your own economy, or we'll do it for you. But Japan's plotting a counterstrike that could flip global trade, alliances, and even the dollar on its head. If you're tired of the sanitized headlines that gloss over the real story, stick with me. We're diving deep into the numbers, the hidden power moves, and the terrifying stakes of what's coming. Let's start with the ultimatum. The US is in a difficult situation. Its trade position is crumbling, with a current account deficit running at 3.8% of GDP, roughly $1 trillion annually, according to the Bureau of Economic Analysis. That means America needs foreign cash pouring in just to keep the dollar from tanking. But foreign investors, including Japan, are starting to lose faith. They are tired of sticking their necks out for the US and buying US Treasury bonds just to help the White House keep funding its bloated budgets. So now the US is staring down a $22 billion 30-year Treasury bond sale in 2025, and the last auction was a wake-up call. Domestic buyers slashed their participation to 14%, down from a 6-month average of 17%, per the Wall Street Journal. Recent news shows that foreign central banks are cutting back on US assets, like treasuries, which is a big concern for America's economy. Data from the New York Fed reveals that US securities held for foreign banks have dropped to their lowest level since 2017. This shift, called de-dollarization, could spell trouble for the US dollar and the country's financial stability. Foreign central banks are holding fewer US bonds and turning to other options like gold, euros, or Chinese yuan. This isn't just a small change, it's a sign of bigger problems. The US dollar has been the world's top currency because other countries trusted and bought dollar-based assets. But that trust is fading, and it's a warning sign. About 85% of central bank managers say sanctions are a reason to hold less. Also, the US government is borrowing too much, with deficits expected to grow by over $3 trillion in a few months. This makes people doubt whether US bonds are still a safe bet. As if it were not bad enough, the dollar has been weak, losing 10 to 11% of its value in 2025, which hurts foreign investors who hold dollar assets. This creates serious problems. Foreign buyers make up about 30% of the US Treasury market. If they stop buying, the US might have to rely on its own people or the Federal Reserve to buy its debt. This could mean printing more money, which could cause the dollar to lose even more value and drive up prices through inflation. Higher Treasury yields could also make borrowing more expensive, putting pressure on the economy. Plus, a weaker dollar means imports cost more, which could make everyday items pricier for Americans. This trend also shows that the US is losing some of its global power. Countries like China and Japan are selling US bonds and buying gold instead. This move away from the dollar could weaken America's ability to borrow money easily and maintain its influence worldwide. While some say this is just a temporary shift, the bigger picture suggests a long-term change that could hurt the US if it doesn't act. To fix this, the US needs to control its spending and rebuild trust with other countries. If this trend continues, it could lead to a weaker dollar, higher prices, and a less powerful America on the world stage. The situation is serious, and the US must take steps to avoid a bigger crisis. But for now, the Japanese pension funds are leading the charge amongst nations shifting their money to euro-denominated infrastructure bonds. Why? Because US inflation expectations are climbing over the next decade, well above the Federal Reserve's 2% target, and Trump's 2025 stimulus plan is set to add $2.4 to $2.6 trillion to the federal deficit, according to the Congressional Budget Office. The US is drowning in debt, which has hit 122% of GDP, and it's running out of buyers to keep the party going. So what does Washington do? Instead of tightening its own belt, it turns to Japan and demands it hike interest rates to strengthen the yen. The Treasury's June 2025 exchange rate report didn't mince words. It demanded that Japan needs to tighten monetary policy to fix the so-called trade imbalance. Translation? Make your exports more expensive so US goods can compete. Sounds reasonable, right? Wrong. Japan's economy is hanging by a thread. In the first quarter of 2025, GDP shrank by 0.7%, exports fell 0.6%, and household spending, over half the economy, flatlined. These aren't just bad numbers. They show an economy too weak to absorb external shocks. Toyota, Japan's economic powerhouse, just took a $1.3 billion hit in April and May alone, thanks to Trump's 25% tariffs on Japanese cars. The company's now bracing for a 20% drop in annual earnings. Over 1 trillion yen in operating income gone. Mazda is in such a panic it delayed its earnings forecast altogether, citing US trade uncertainty. What we're seeing isn't negotiation. It's economic warfare, and Japan is the one taking the hits. Supporters argue Trump's pressure aims to level the playing field. But in Japan's eyes, it's a one-way street. Now let's talk about Japan's bond market, because this is where things get really scary. Japan's debt-to-GDP ratio is a jaw-dropping 236%, the highest in the developed world per the IMF. The Bank of Japan, BOJ, holds 80% of its own government bonds, with a balance sheet ballooning to 126% of GDP. For years, Japan kept interest rates near zero through yield curve control to manage this monster debt. But in 2024, they ended that policy, and by January 2025, rates were at 0.5%. Then, in May, 30-year Japanese government bond yields hit 3.15%, the highest since 1999, and 40-year yields spiked to 3.635% per Reuters. Why? Markets are betting the BOJ will have to raise rates again, partly because of US pressure, but also because Japan is planning fiscal stimulus ahead of its July 2025 upper house election. If rates keep climbing, Japan's bond market could implode. Higher yields mean losses on the BOJ's massive bond holdings, and with negative yield spreads already squeezing its balance sheet, a sharp hike could trigger a financial meltdown. Deutsche Bank estimates Japan would need a 20 to 25% yen appreciation to meet US trade goals. That kind of shock would crush exporters like Toyota, already battered by tariffs, and could send Japan's economy into a death spiral. You might be thinking, why doesn't Japan just say no? Well, they're trying, but it's not that simple. Bank of Japan's Governor Kazuo Ueda is pushing back, warning that household consumption is too weak for aggressive rate hikes. Inflation in Japan is running above the BOJ's 2% target, but it's driven by painful essentials like fuel and food, not robust demand. A stronger yen might ease import costs, but it won't jumpstart consumer spending. In this kind of slowdown, tightening policy could do more harm than good. In a May 2025 Reuters poll, 68% of Japanese economists urged the Bank of Japan to hold off on rate hikes until trade policy settles. Behind closed doors, BOJ officials are even considering delaying bond tapering beyond Q4 2025 to prevent market instability. But Washington isn't listening. Treasury Secretary Scott Bessent, Commerce Secretary Howard Lutnick, and U.S. Trade Representative Jamieson Greer can't even agree among themselves. According to Bloomberg, talks with Japan were temporarily suspended after internal U.S. infighting derailed negotiations. Japanese officials are growing frustrated, saying it's impossible to respond when the American stance keeps changing. The constant back and forth from Washington is wearing down trust and pushing Japan to rethink its role as a dependable U.S. ally. Here's where it gets wild. Japan isn't just sitting there taking punches. They're planning a counterstrike that could change everything. Instead of bowing to U.S. pressure, Tokyo is looking to the Comprehensive and Progressive Agreement for Trans-Pacific Partnership, CPTPP, to reshape global trade rules. This 12-country trade group is something Japan helped keep alive after the U.S. dropped out of the original Trans-Pacific Partnership in 2017. In Q1 2025, Japan's exports to CPTPP countries jumped, especially to the Middle East, with a 17% increase. Japan even entered new trade agreements with the UAE to further reduce its dependence on the US. And shipment of cars to Mexico and Canada are leading the charge. But Japan is not just making noise. They know what to do to hurt the US economy. They're waving a big red flag, hinting they might dump their massive 1.1 trillion stash of US Treasury bonds if the US doesn't back off. Japan's finance minister Katsunobu Kato tried playing nice at first, saying they wouldn't use their Treasury holdings as a weapon. But by May 2025, he flipped the script, dropping a bombshell. Those bonds are now a card on the table. Translation? Japan's ready to play hardball. If they start selling off those bonds, it could send US interest rates through the roof, tank the dollar, and throw Wall Street into chaos. Remember the Treasury sell-off panic in April 2025? This could make that look like a warm-up act. Sure, Kato backpedaled, saying there's no plan to sell yet, but the message is clear. Japan's not messing around anymore. Prime Minister Shigeru Ishiba is calling this a battle for national interests. And with an election coming up on July 20th, 2025, he's under pressure to show Japan won't be bullied. The Japanese are pushing hard for the US to scrap these tariffs entirely, especially on cars, which are the lifeblood of their economy. Negotiators like Ryosei Akazawa are hitting a brick wall, offering deals on agriculture and natural gas. But Trump's team isn't budging. It's a standoff, and Japan's realizing it can't rely on the US as its buddy anymore. They're waking up to the fact that they've got to put Japan first. So how's Japan protecting itself? The Bank of Japan is keeping interest rates super low to cushion the blow from a weaker yen, which is getting hammered by these tariffs. They've already stepped into currency markets before, like in 2022 and 2024, to prop up the yen, and they're ready to do it again. Japan's also doubling down on investments in the US, trying to keep some goodwill alive, but let's be real. This is about survival. They're not just sitting back and taking it. Now let's talk about the real catastrophe. Trump's wrecking ball approach. These tariffs aren't just hurting Japan. They're torching a decades-long alliance that's kept both countries strong. Japan's been America's biggest foreign investor and a key partner in the Pacific, especially against China's growing clout. But Trump's America-first obsession is pushing Japan to rethink everything. Ex-posts are buzzing with Japanese frustration, with some saying it's time to cut loose from the US and go it alone. If Japan starts dumping treasuries, it's not just their problem. It's a nightmare for the US economy. Trump's burning bridges that'll take years to rebuild. Japan's not just another trading partner. It's a cornerstone of global stability. By picking this fight, Trump's forcing Japan to prioritize itself, and they're ready to use their financial muscle to do it. If this escalates, the fallout could be catastrophic, and the US will have no one to blame but itself. So what happens if Japan makes the next move? The global economy could shift overnight. Hit subscribe and stay with us, so you don't miss the next shockwave.